Now, how do we actually navigate the process of allocating capital to these multifarious financial assets? One term that we're going to use very often in this class is portfolio, which is to say a collection of invested assets. All the money that you have deployed, it has bought you a certain basket of financial assets, some bonds, some stocks, maybe some derivatives. All told, they make up a portfolio. How did you actually create this portfolio? Well, it usually comes in two parts. There's first an asset allocation decision. In other words, how do you split up your capital between asset classes? How much do you put in debt? How much do you put in equity? How much do you put in derivatives? You might have heard in personal finance a classic recommendation, which is a 60-40 portfolio. Now, what is a 60-40 portfolio? That's a portfolio that has 60% of its capital allocated to stock, 40% allocated to debt, 0 allocated to derivatives, because in personal finance, usually advisors will not recommend individuals to get involved with derivatives just because they're too complex and too risky. So this would be one example of an asset allocation. But literally any other, 30-30-30 between debt, equity, and derivatives, maybe the rest in cash. That would be another type of asset allocation. And now within the asset classes, there is an additional decision that needs to be made, which is security selection, the choice of individual financial assets within the asset class. So let's say you put 60% of your capital in bonds, in stocks. Well, which stocks do you hold? Do you buy a certain amount of Amazon or Microsoft or Beyond Meat, Tesla, what have you? How much of each asset you choose, how much of each stock, that is the security selection decision within the broader equity asset class. Similarly for debt, similarly for derivatives. And so how do you integrate these two? Well, you can make the allocation decision first and then make selection. That's what we call a top-down approach. And that's what the 60-40, for example, allocation to equity and debt recommends. You split up your money between asset classes first, and then you choose what individual debt and equity securities you invest in, or maybe what ETFs or mutual fund portfolios of those securities you invest in. So first you do asset allocation, then you do security analysis to determine selection. Whereas the alternative is a bottom-up approach where actually you just look at the attractiveness of individual securities without worrying about what asset class they belong to, and just deploy your capital that way. The downside of potentially doing it this way, the bottom-up approach, is of course that you might end up overweighting a certain asset class. Maybe equities are really cheap in a certain period of time, so you put all of your money in individual equities, and once you've allocated it all, well, you come to realize that your portfolio is made up of 90% equity and only 10% of debt. That can be more risky than intended. So especially for sort of newcomers to investment, top-down approach is advocated where first you allocate between asset classes, and then within asset classes, you actually do the security selection. So financial markets are competitive mostly because of how transparent they are. The prices are known to everybody, and of course how much there is at stake. If everybody can participate, and if the data is mostly visible to everyone, then the investors with the superior analysis should end up profiting. Those with inferior analysis will make worse decisions and will end up losing. So that means that generally markets are considered quite competitive. Prices are considered to be fairly representative of true values. And it means that there is what we call a risk-return trade-off. If market prices are set reasonably, we should expect a higher risk asset to offer a higher expected return than a lower risk asset. Mostly because all of these sort of kinks in pricing have been already ironed out by market participants. So all that remains is just how much risk you're willing to take on and how much return you're actually entitled to for bearing that risk. Now we're going to talk a lot in this set of lectures about the math that'll actually determine your level of risk, how you can measure that, how you can translate the amount of risk to the amount of return that you may expect. But the math is essentially trying to capture this intuition that there is a risk-return trade-off, and the reason that it exists is because markets generally are considered to be reasonably efficient, and the prices are set in a reasonably competitive fashion, reflecting really what will drive future performance, which boils down to risk. That means that risk and return are positively correlated. Essentially, expected return is the compensation that you get for bearing a certain amount of discomfort of taking on higher risk. You know, you buy a security, let's say stock. Remember, it's bottom most in that pecking order of precedence for repayments. That means that you should expect a higher return than a bondholder within that same company. So the return to the bond of a company should always be less than the return to the common equity of that company, because the common equity holder bears more risk. They're last in line. They have that residual claim. That means that if things are good, well, they get a lot. If things are bad, they may get nothing. That means that their expected or average return should be higher than that for the bondholder, who is pretty much guaranteed a certain amount of payment, the coupon plus principal, and is first in line to receive it. And this idea that risk and return go hand in hand is also related to the idea of market efficiency. In other words, the idea that prices really capture all relevant information fairly quickly. What follows from that idea, if prices really do, is that there really shouldn't be securities that are underpriced. There shouldn't be securities that are overpriced either. That means that really the fair price of a security should be the amount of risk that it exposes the investor to. But, and we'll talk about this later, markets are not perfectly efficient. Some markets are more efficient than others. Generally, markets that are more active will be more efficient than markets that are less so. So if you think about, you know, is the price of, let's say, a house always reflecting the true value of that house versus the price of a stock reflecting the true value of that stock? Well, the stock's probably more likely to reflect actual value simply because there's more people looking at it and more people trading it than a house. And similarly, within, let's say, the universe of stocks, a large cap US stock is more likely to be more efficiently priced than a small cap emerging market stock, again, because there's more eyes on the large cap US stock and there's more trades going on in the large cap US stock than in a small cap EM stock. So you shouldn't think of efficiency as a binary on or off thing. It's more of a continuum. And the more market participants there are, the more transparent and active the market there is, the more efficient it will be. The less so, the less efficient it will be. And so how do people navigate these reasonably competitive markets? Well, the two main investment philosophies are passive and active investment management. In passive management, that's essentially this idea of index investing that we talked about a few slides back. You will hold a highly diversified portfolio. You won't really try to find undervalued securities. The highly diversified portfolio you hold will often be a ETF or index fund that literally holds all the securities within a certain population. And you won't really attempt to enter and exit to time the market. You will just hold until your investment horizon actually arrives. Now, active management is in contrast to this. Essentially what active managers try to do is they try to find these market inefficiencies. They try to find securities that are underpriced. They will try to enter and exit the market at what they believe to be opportune times. And if we believe the market to be efficient, really this active management idea becomes less and less worthwhile the more efficient we believe the market to be. If there is no mispricing, well, that means that you can't really do this bit of it. And if prices are always right, well, then there's no point in trying to time market prices. So the very fact that active managers exist suggests that the markets are not perfectly efficient. At the same time, since not all active managers actually manage to beat a passive strategy, it suggests that markets are reasonably efficient. So again, think of market efficiency as sort of a continuum, and think of these investment strategies as ones that you might want to follow depending on where on the continuum you believe markets to be. If you believe, if we go from inefficient to efficient, if you think you're closer to this part of the continuum, closer to inefficiency than efficiency, you might actually want to do active management. Whereas if you think that you are closer, or the market you are looking at is closer to efficiency than inefficiency, well, then you might want to do passive management. So the investment strategy that you will pursue will depend on how competitive and efficient the market actually is. So who participates in the capital markets, which is to say not just debt, but also equity? Who participates in the buying and selling of financial assets? Well, who supplies capital? Well, it's households at bottom, of course. Households will put some of their wealth in financial institutions, but at bottom, all the wealth, all the capital that there is, belongs to individuals. So they, the investors, are the suppliers of capital, and generally what we expect is an upward sloping supply curve. The more capital is demanded, the higher the price will be. Capital is scarce, so as with any scarce good, the higher the quantity demanded, the higher the price. Now, who demands capital? Well, who actually uses it to finance real assets? Well, it's firms. And the demand curve for capital we expect to be downward sloping, because the more costly the capital, the less of it a company will actually want to use. Think about it this way: if you can't get a loan unless you can pay 10% in interest, well, that'll limit a lot of what you can do with that loan. You're going to have to invest in something that earns a 10% or greater rate of return, If you fail to earn that rate, you will go bankrupt. So you'll be very careful about actually choosing to accept that expensive capital. But as its price, in other words, its required rate of return goes down, you may actually be more and more comfortable deploying capital, and so you will demand a greater amount of it. And for any particular financial asset, the actual price, which is to say the required rate of return, will be defined at the intersection of supply and demand. So remember, the price is actually the rate of return, the yield on a bond, the combined dividend and capital gains on a stock, those will be determined at the nexus of investor supply of capital and issuer demand for capital. I guess the bottom line here is that capital really is sort of like any other commodity. It's determined at, its price is determined at the intersection of supply and demand. What does the government do? Well, it can actually be either a borrower or a lender. Obviously, the government borrows by issuing those treasury bills, but it can also lend. So things like the Small Business Administration will issue capital to try to help small businesses get off the ground. The government sponsors these agencies to promote mortgage lending, indirectly or directly. So the government can actually serve both roles, being a borrower or a lender. And in fact, this role of government is important in stabilizing the capital markets. If there is all of a sudden a big pullback in the supply of capital by households, the government can step in, maybe through the Federal Reserve, to lend more. And if there is maybe an insufficient demand for capital, the government can step in and borrow more through the sale of treasuries. How do financial intermediaries fit into this if, remember, all capital is owned by households? Well, financial intermediaries are actually the ones that pool capital from many different households and then invest the funds. And the different flavors of a financial intermediary can be investment companies, private equity, hedge funds, mutual funds, banks, insurance companies, credit unions. The reason that we call them intermediaries is precisely because they take capital from investors, from households, and they deploy it in the capital markets. So in other words, they're sort of like the middleman between households and firms. And it's not like they're an unproductive middleman. If an individual household might not have the time to really supervise or review different investment opportunities, that's the value a financial intermediary can add by essentially doing that capital allocation task for the household, guiding household capital to the most productive and therefore the highest earning investment opportunities. Now, a big category of financial intermediary is banking. Banking is broadly split into two categories, investment banking and commercial banking. Investment banking can underwrite new securities issues. In other words, it can help firms issue more debt, issue more equity. and it can sell these newly issued securities to individuals in what we call the primary market. In other words, if there's a company that first comes to the market, they haven't had common stock traded before, well, what they'll do is they will go to an investment bank. An investment bank will then sell, or will actually help sort of create the IPO that will sell this new equity security to households, and that's a primary market transaction. A commercial bank will instead take deposits from households and will make loans, either to other households or to firms. So an investment bank will more help with the marketing and creation of new securities. A commercial bank will help with the origination of loans and the financing of those loans from deposits.